All right, it is 6:30, so we do want to, be conscious of everybody's time. Thank you very much for coming out tonight. We really do appreciate everybody who made the effort to come out here. So thanks again. As I mentioned, we are doing a hybrid virtual for a few who weren't able to make it. So for those of you who are online, if you do have questions, feel free to type them in the question and answer box, and we'll have somebody on the team read them out. For everybody in person, if you've got questions as we go, feel free to interrupt, ask. We're here to answer your questions. It's meant to be interactive. I'm going to take a little bit of time tonight and just go through sort of a couple of things, brief introduction of who we are, who the Kilgore Group is. Most of you here know who we are. We're going to talk a little bit about understanding some of the components of estate planning, spend a little bit of time on death and taxes, mostly through some examples here, as I find that's the best way to learn. And then going to talk for a moment about being an executor, and then we are going to invite Linda up. We're very happy to have her here. She is the resident estate expert in terms of all the legal questions you have, all the questions you have on wills and powers of attorney and probate. Linda will be up here to answer as well after. So feel free to make notes if you have questions along the way and shout them out and ask them. So just very briefly, come on in, grab a seat. Who we are, we believe that, it really does take a team, and that's why we wanted to gather here tonight. At the Kilgore Group, we want to work with your existing advisors. We know how hard it is to get an accountant, a lawyer, a financial planner all in the room together. So we've offered you sort of that opportunity tonight to kind of look at what a plan should look like, how it's going to move, how it's going to be cohesive, work as part of a team. The Kilgore Group here tonight, we are part of Investors Group Securities Inc. We're one of the companies under IG Wealth Management, which is a part of IGM Financial. And ultimately, our parent company is Power Corp. Very large company. For those of you who are local here and know, Power Corp was actually started by the Desmarais family. It actually started as the Sudbury bus lines, busing out to the mines back in the day. It is now a huge world powerful company, which is kind of a neat local story here from somebody who started out with a bus line in Sudbury. For those of you who don't know me, my name is Lindsay Kilgore. I am the senior financial advisor here at the Kilgore Group. I have been doing this now since 2008, hard to believe, and really do enjoy working with everybody I get the opportunity to work with. I love my job. I've been a certified financial planner for years. I had the honor of being on the president's list when I wrote my financial planning exam for being second in the country. Since then, I've got my master financial advisor. I'm working towards my certified life underwriter. So if you have questions, I'm here to answer any of them for you. You can also find Jake standing at the back of the room over there, or sitting, I guess now. He joined the team a couple years ago. Jake's come from Roynat. Brings a wealth of knowledge to the table, got his MBA, a great person if you have some questions, if you want to ask anything. He's there as well to answer any questions. Chandra's at the back also. She joined us now 3 years ago, completed her MBA while she was working here with us at IG. Again, wealth of knowledge we have in this room. Erin's not here tonight, but I'm sure all of you know who Erin is because she's sent out all the invites. She's who you really need to contact if you have questions for any of us. And we're really happy to have Brett Tucker here tonight as well. He is our regional estate and insurance planning specialist. So he's also here to answer questions, and we'll all stick around for a little bit after if you have any questions. We're here to provide information. What does wealth management mean? It really means we're here to use our expertise to answer your questions, put it together, make your life simpler. That's really our goal, is to use our knowledge to help our clients achieve their goals. And our approach to wealth management is very simple. We believe it starts with you. It's your goals. What do you want to achieve? It all stems down from you. Then we look at tax planning. We bring in the experts. Then we look at what products match that. So we want to bring it all fitting around you. Tonight, we're here to talk more about estate planning. So we're not talking about the whole planning. We do holistic financial planning, but we really want to focus tonight on estate planning. It's a part of the plan that doesn't get a lot of attention, probably doesn't get the attention it deserves. It's the afterthought. So we're going to chat about that a little bit tonight. So what is the first piece of estate planning that everybody thinks about? The centerpiece of your estate planning is your will. So your will names your executors, it names your guardians, it talks about treatment of your assets, but it talks about treatments of the assets that flow through the will. So not everything flows through the will. Things with beneficiary designations, RSPs, tax-free savings accounts, insurance policies flow outside the will. The will governs everything that goes through the estate. So we're going to talk a little bit about that. Linda's here to answer any questions you may have, like I said, about the will, about the estate. She is a wealth of knowledge when it comes to that, and really going to go through that with you. Again, I'm not going to spend a lot of time talking about the roles of the executors and the legal pieces of that, because we have Linda here to cover that, and she'll tell you all the do's and don'ts. But what I am going to say is, when you pick your executor, one thing you want to know is, who are these people? Why did you pick them? Sometimes the fact that they're your sibling or your child or your parent isn't the best or only reason to pick them. You have to ask yourself, do they have the experience to deal with this? Have they been an executor before? Do they know what they're signing up for? Do they have the same values as you? Are they going to work through the same plan as you? Are they going to work with the same advisor as you? That's a really important thing to know. Not part of the will, but power of attorney. Most people draw up at the same time, I would say. There's power of attorney for both health and financial. Again, why are you picking your powers of attorney? They don't have to be the same person for health and financial. The person who's going to make the medical decisions as to whether or not to pull the plug might not be the same person you want to have running your investment portfolio. Often they're not. People have different skills. Let's just say that. Maybe there's a reason you want them separated. But it's important to think that through. And is the person who's going to be your power of attorney or the same as the person who's going to be your executor, right? Those are a lot of important questions to ask. And are they going to be working with the same advisor you've been working with? So they know your plan, they know what you've done, or are they coming in with their very own idea, and they're going to be the type of person who's going to kind of put their head down and say, well, I'm doing it my way, and too bad what they've set up for me. You know your family, you know your people, you know your friends best. Think about who you choose. It's important. Digital wallet. So this is kind of a new thing that we are, I guess not new, but we're talking about a lot more now when you talk about wills, power of attorney, digital wallet. And what the digital wallet is something that should be held with all your information when you pass away, your passwords, things as simple as your phone login. Nobody's gonna be able to hold it up to your face or your fingerprint. You need your password. Your loyalty programs, your points, all of those things, right? Some people have quite a bit of Aeroplan points and PC points and all of that. It typically should be mentioned in your will, and I think Linda can talk to that. I know she always includes it in the wills that she does, and a clause for that. But just how do you find them? How do you get them? Cryptocurrencies, things like that, of course, as well. Social media logins, so you can cancel your social media accounts, all should be held in there. Photos, you own your photos. If there's no way, if nobody inherits your photos, if nobody can get into your accounts and your phones, think about how horrible it would be. Grandma and grandpa pass away, and gone are all the pictures of the days that grandma and grandpa spent with the grandkids, because the photos are gone, right? It's an important piece of the puzzle that doesn't get a lot of attention because nobody's really thinking about that. So we're going to get a little bit more into some numbers, some details, some planning pieces on top of that. So a little bit about death and taxes. Taxes, death, more taxes. It is the reality. So we're going to go through some examples here. But I do want to point out that in all of the examples we're going through, we've assumed that these people have already been through the planning process. They're examples of things we've seen and lived through ourselves. So we already know that their retirement is taken care of. For example, we're not having examples in here of younger families where they need life insurance and it's going to be a crisis. We've assumed that they've had insurance needs analysis and the lifestyle things are covered, and we're now talking more from a focus on death. So if that's not the case, absolutely everybody should have those pieces done first. But we're going to talk a little bit through some examples. So what happens when you die? Your executor is going to file your final tax return. They're going to report all of your income or deemed income, and that tax bill can be huge. It can be a lot bigger than you think. And the reason for that is people don't necessarily understand the difference between income tax at death and probate. We like to call probate the little tax. Probate in Ontario is about 1.5%. It's not that much. What happens is we all get American TV, so we're all worried about death tax. We live in Canada, we live in Ontario. Death tax is not the big number. Income tax at death is the big number. Income tax at death is what you really should be planning around, because when you pass away, any income you've had in a year, your pensions, your interest, all of that becomes part of your income. But there's a deemed disposition of capital assets. So if you have a camp, if you have a hunting property, all of those things are deemed to be disposed of. There will be a capital gain at the time of disposition. 50% of that is taxable. Any registered assets you have, RSPs, RIFs, all of those are deregistered and they're included in your final tax return. Now, there are some options for deferral and minimization. If you are lucky enough, I don't know how to say that, to be the first spouse who passes away, you can roll it over to the second spouse. You can have, there's different strategies with, trusts and those types of things. You can do some charitable giving. If you do donations, that'll minimize. There's the principal residence exemption, but ultimately there's quite a bit of tax. So let's look at a few examples. I find this is, the most enlightening thing. I'm going to go through some simple examples fairly quickly, but if you have questions, stop me. The numbers are small on the screen. I totally get that. The numbers aren't the most important thing. It's just to give an example. So let's start with Tom. Tom is widowed, so he is now single. He's got a reasonable sort of average, net worth. He's got his house. It's for $300,000. He bought it for $200,000. He's got a cottage. His camp's $200,000. He bought it for $100,000. He's got some modest RSPs, $150,000. Some money in his tax-free savings account, $20,000, and some non-registered investments, $100,000 of non-registered investments. So Tom is single. He cannot roll assets over to his spouse. And we're going to assume we have to kill him off at some point in the year. We're going to kill Tom off on June 30th. So he's lived half of the year. He's collected half of his pension, half his CPP, half his OAS, half his dividends. But before we look at what the example is of what Tom's income tax is the year he dies, what I want to note is if Tom had lived for the whole year, if we had not killed him off in June, his total taxes in 2021 would have been just shy of $23,000. So, a decent amount of tax, but nothing too crazy and what he was expecting. But we're going to kill poor Tom off halfway through the year. So Tom dies halfway through the year. He's got half his pension, so $35,000, half his CPP, half his OAS, half his dividend income, so $48,000 of income. Is his house. It has no tax implications. It's his principal residence. Is the camp. So that's $50,000 of capital gains that he has to add to his income. Is his RSPs, which he has no spouse to roll over to, so $150,000 of income. And then he's got approximately $10,000 of capital gains on his non-registered investments. So Tom's taxable income in his final tax return is $258,000. So remember, Tom only pays 21 if he lives. If Tom dies, or 23, sorry, if he lives. If Tom dies, he actually pays $101,000 in taxes in the year of death. And that's because he's pushed into the higher marginal tax brackets. His OAS is clawed back because he's over the OAS clawback line. Tom was not a millionaire, right? Tom was sort of an average Joe in that example. It's easy to fall in higher tax brackets in years of death. So it's something to keep in mind, right? We have to plan ahead for these things. So that was Tom. Tom was single. Let's look at another example. Rob and Jen are not single. They're happily married. They're retired. They're enjoying life. Jen was a teacher. She has a defined benefit pension. Rob was an employee of a company that offered a group RSP. Life was good. They planned to live together. Things were going well until unfortunately Rob passed away. Again, we have to kill poor Rob off at some point. So we're going to kill Rob off on February 28th. He was 70 years old and he leaves Jen as a widow. She's healthy. She's still active. She still wants to live life. Now, before Rob died, this is what their income looked like. Jen had a pension, she had CPP, old age security, so her income totaled about $84,000 a year. Rob was taking RIF income, he was taking about $20,000 a year, CPP, old age security, he brought in 39. They had a good accountant, they did pension splitting. So at the end of the day, the household taxes were about $21,000 and the cash flow was $101. That let them live life. That's what they wanted to do. They were able to travel, they were able to enjoy retirement. Unfortunately, Rob died. When Rob died, he had his RIF. He didn't have a pension, so he had contributed to an RSP his whole life. $400,000. They had the house. Fairly simplified estate. What we often see is that people assume because you can roll over the RIF at death of the first spouse, that it's the right choice. They want to minimize tax in the first year. They go to the bank, they find out they can roll it over and pay no tax, and they say, yay, I want to pay no tax. And nobody ever looks ahead from that point. So they did this. They paid no tax, they rolled everything over. They thought life was good. But what happens to poor Jen? Jen is still alive. She still has to live with this. So she has two choices. Jen can be happy with less money and only take the RIF minimum. The RIF minimum in the year after would have been $16,000. So Jen has a total income of $100,000. She's now got $22,000 of tax. She's got old age security clawback because she's over the threshold, and she only has $74,000 of cash flow. Well, just because Rob died doesn't mean Jen doesn't want to travel, and now she's going to go with her girlfriends to Florida, and she's going to hire somebody to, cut the grass while she's away, or whatever the case may be. What if Jen wants to spend the same amount of money? She's just learned that life is short, and she doesn't want to be, worried about that. If Jen wanted to spend the same amount of cash flow when she doesn't have Rob to split income with, she actually has to take $68,000 per year out of her RIF for a total income of $152,000. She's got bigger tax bill, full old age security clawback. So to get $101 of cash flow, the same number she had before Rob died, she's got to pay $50,000 in tax a year. That's going to deplete that RIF a lot faster, right? So what are the options? They could have done things differently. Planning before you die is obviously the best scenario. Everybody's alive and we can have conversations ahead of time. But just because one spouse has died doesn't mean you stop planning and doesn't mean you have no choices. You have some options. So let's assume, Jen did come to us after Rob passed away. We weren't able to do too much planning ahead of time, but we were able to look at a few options, the rollover being optional. She could have triggered all of his income. She would have had a substantial tax bill. Actually, she would have had an $18,000 tax bill. He would have had a substantial tax bill, right? He would have had $400,000 worth of income and paid $177 in tax. Not ideal. That's a pretty big upfront tax bill. On the flip side, though, Jen now has $222,000 she can spend to do whatever she wants without worrying about old age security clawback. She's got flexibility. And when Jen passes away, she's not, from the first scenario, she doesn't have the RIF. But more importantly, it's not an all or nothing. So what we looked at is, okay, how much could we trigger to reduce the RIF? Maybe it's half. And we had some conversations about what she actually really did want to spend now that he's gone, and said, okay, we can trigger half. We know what's left in the RIF. We know what the RIF minimum is going to be. We can make a plan with that moving forward so you don't have crazy tax bills. We can know that with the amount we're deferring and the amount we're paying now, you've got more than enough to get you through to age 100, because our goal is to support your lifestyle, right? It's about what you want to do. Jen wanted to travel. She didn't want to take the minimum so her kids got, the death benefit in the end. That wasn't the plan. So we were able to create a solution that said, okay, this works for you. Even if Jen did not want to travel, she decided she wasn't going to go on her own. She was going to spend less. It turns out Rob was actually the big spender with the credit card problem, and she never did anything. We would still talk about triggering up to the top of the 30% tax bracket, because Jen is never going to be in a lower tax bracket. So we were able to have some conversations and say, does it make sense to trigger? Does it not make sense to trigger? We were able to bring the accountants into the conversation as well. Look at that whole picture. How does this work, and do the rollovers? So again, there's lots of different things in there. This is one of my favorite examples. I call it the probate trap. I always feel like I should end that with like, dun, dun, dun. The probate trap is one of the most common things we see out there. Is people hear probate. And again, we get a lot of American TV, so people hear death tax and don't necessarily understand what it is. So we're going to walk through this example. Mary was mom. She was 80 years old. She was now single. She has no house. She hasn't owned a house. They rent it all along, but she does have the family camp, which she plans to claim as the principal residence. She has a RIF worth $300,000. That's what she's living off. And she has some GICs worth about $150,000. She has two kids whom she loves equally. She wants to split the estate equal, and she wants it to be fair. That said, her son lives in Sudbury, goes to camp every weekend, grandkids are out there, loves the family camp. The daughter's out west in BC, never comes to camp, not an outdoorsy kind of person, has no interest in maintaining the family camp. Very, very, very common. She is not the only one we've seen in this scenario. What happens is somebody told Mary that there was probate when she was going to die, and the government was going to take a huge chunk of her money. Again, didn't really explain what that was, but told her about it. So to avoid this, Mary did what many moms do. She named her daughter as the beneficiary on her RSP, and she put her son as joint owner on the camp. Her goal was the daughter was going to get the $300,000 of the RSP. The son was going to get the camp, and then she would leave her son as the sole beneficiary of the estate. So the son would get $300,000. I'm not even going to touch on putting your kids as joint owners on your camp. I will let Linda talk to you about all the reasons we never recommend you do that. But what happened from a tax perspective and from an estate perspective? Before I jump into that, again, probate is the little tax. Probate is 1.5% in Ontario at the top end. It's actually lower than that. So to avoid 1.5%, you can create a lot of legal battles and a lot of fighting and a lot of animosity between your kids, which was not Mary's initial goal. She loves her kids equally. So had Mary died with this being the case, what would have happened is the RSP would have passed to her daughter outside of the estate. She had a named beneficiary. The $300,000 goes to the daughter. There's no withholding tax. So people assume when you die, it's the same as when you're alive. It is not. When you die, the money goes to your beneficiary, the bill goes to the estate, the tax bill we talked about. The cottage went to the son outside the estate. It was $150,000. It did pass to him outside the state. The GIC went through the estate. The income tax bill from that RSP for $122,000 went to the estate, and the GIC had to be used to pay it. So the daughter got $300,000, the son got $177,000. Not what mom was looking for. And this can be a lot worse if there was actually a capital gain on the camp because mom owned a house at one point in time and just doesn't anymore, right? So it's something to seriously consider because she thought she was being fair, right? She was just trying to avoid probate. And in avoiding probate, again, 1.5%, things aren't fair. And what's going to happen? The kids are either going to fight, battle it out in court, and most of that will go to be wasted in court anyway. It's just not a great scenario. You're relying on them to be nice. So planning ahead can help. So at this case, let's assume Mary and I met. She met our team when she was 60 years old, and she told us, again, her goals. That's what it comes down to. What are you trying to achieve? And she said, I want my son to get to camp. He's out there every week and he puts in all the work. He's the one chopping wood, driving the boat, fixing everything up. I said, great, we can do that. But I want it to be equal. I don't want my daughter to be left out just because she's not outdoorsy. Doesn't mean she doesn't get the same amount. It just means she needs something different, right? Anybody who has kids knows that both kids usually don't want the same thing anyway. So we talked a little bit about an alternative investment option. We said, what can we do that allows you to take care of yourself, but that is a little bit more tax efficient? And this is a really blurry slide and it's a little bit small, so I do apologize on the screen. But we talked about an alternative investment, and we said, what if you put that money, what if we took some of that GIC money and we moved it into what's called a whole life policy? So at 6 years old, we made that decision. We were going to take $4,000 a year out of the GIC, and we were going to put it into an alternative investment. So now Mary's 80 years old. She's a single woman. She has no house still. She has the family camp that she's going to use as the principal residence. Her RIF is still worth $300,000. Her GIC is only worth $68,000 because we've moved a portion of that GIC into an alternate investment. And the alternate investment is a whole life policy with the death benefit of $163,000. So now what happens? Now we have everything run through the estate. The RSP goes through the estate, the cottage goes through the estate, the GIC goes through the estate, the insurance goes through the estate, the income tax bill goes through the estate. Yes, you paid $9,500 in probate, but the kids aren't fighting. So there's some options there, right? At the end of the day, both kids walked away with $274,000 equal. They were able to, out of that value of the estate, get the camp. Again, I'm not going to talk about the mechanisms in the will, but there are definitely ways you can set up your will to allow one child to buy the camp out of the will. especially if one doesn't want it. It's quite simple. So it's one option. 90% of the time when we show that option off the top, first thing people say is no, I don't want insurance, right? It's about me first. My goal, yes, my goal is the kid gets the camp and it's equal, but it's about me first, 100%. I am an absolute believer that an estate is not something that you should be guaranteed to give your kids. Your kids shouldn't expect an estate. They get what's left. It's about you and taking care of you first. But in the way we did it this time, we talked about, okay, we can do both. We can make sure that we set it up as an alternative investment. There are different types. Not all insurance is the same. Not all mutual funds are the same. Not all stocks are the same. There are different types. So in this case, we said, okay, what if she needs it? What if she doesn't die at 80, but she has a really big birthday party at 80 and decides to blow all of her money? She thought she was going to die at 80. Turns out they revived her and she's not dead. She's 90 now and she needs money. She spent it all. She didn't plan to live that long. The alternative investment, the whole life policy we illustrated before, the $4,000 we were putting into that policy, has a cash surrender value of $173,000 that she can go in and access. So I'm showing her accessing that at 90, but she can access that throughout. So if 80, she blew all the money and she wants to go in and get another 160 to support her lifestyle, she can do that. Because again, the kids get what's left. That wasn't the point, but the point was setting it up right so what is left is tax efficient. Just a couple more examples, but I hope some of these things are resonating with you, and you can feel yourself in some of these examples, right? These are not crazy numbers. They are cases that happen every day locally, people we all know. So this example here was about business owners. I don't know if we have any business owners necessarily listening at the moment, but we'll walk through this as well. Again, very common. Husband and wife worked in the business. They worked their whole life to build a business, and that was their retirement plan. The intention was they were gonna, enjoy life together and live together. And unfortunately, Jane died early. She died at 65, and actually Joe followed 1 year later. So we're gonna walk through some examples. So Jane died first. Joe had what was left. So Joe's net worth after Jane passes, he's got a TFSA, 60,000. He's got an RSP, 20,000. He's got his house worth 500,000. Most of Joe's net worth is in his business, right? He's worked hard. He's built a business. That's very common. We're going to assume the business has, $2 million of investment. There's about $1.05 million invested initially. What happens when Joe dies? Again, this is a little more complex. I'm not going to go through. Corporate business structures have lots of complexities and RDTOH and CDA and all these complex acronyms and terms. But what I really want to highlight is, first, there's income tax in the company because the $2 million of investments had to be sold. There were capital gains that had to be paid in there. So there was tax in the company. Then there was a payout from the company to the estate because the company was also liquidated and closed. And that payout also created a tax bill. So there was kind of two tax bills in there, the corporate one and the personal one. And when we look at the actual total taxes paid between the personal and the corporate, it was about $787,000. So his, $2.6 million estate turned into 1.8 really quickly. So again, there was some planning that was done ahead of time. We actually met when they were significantly younger. They obviously didn't plan on dying early. So we had a plan to pass the estate over, when the time came, hopefully at their 90s. It's usually when we try and plan that when you're young and healthy. We hope you have lots of longevity in there. But the real goal was, again, they wanted to retire. They wanted to enjoy those retirement years. They worked really hard for their money. It was first and foremost for them. And whatever was left, they wanted to go to the kids, not the government of the day. So again, we talked about, is there an efficient way to transfer money, an efficient way to invest money within the corporation and then transfer it at time of death? Once again, as always, it's very blurry, but they said no. No insurance right away. That's the first answer you hear. We said, okay, but it's not traditional insurance. We're going to do this as an investment. We're going to do whole life as an investment. This is planning for you to live till 90. My goal is not for you to die early. We want you to live a long, happy life, and we want you to have access to this. So we actually created a plan where we carved out $10,000 a year for 20 years from the investment. So they were building that 2 million. We put $10,000 per year into this policy. The plan was they were going to live off their RSPs and corporate investments from the time they turned 60 to 70. They were actually going to take money. They were going to take about $11,000 a year out of the whole life, out of the alternative policy until they were 80. And at 80, they figured they'd slow down. They probably wouldn't travel as much. You know, they'd be happier living a little bit less and sticking around the home. And they were going to plan on living till 90. The plan worked like that, right? They had, and this is a really busy slide, but they were able to put the money into the policy. They were able to take the $11,000 out. We first and foremost wanted their retirement plan to work. We wanted them to live till 90. We wanted them to have fun. Unfortunately, they did not. Sometimes we don't get control over those parts of things, and people do die prematurely. But what happened is we planned for them to live, but we had a contingency plan that was tax efficient for when they passed away. So in this case, having that whole life as an alternative investment strategy increased the value of the estate by about 20%. It allowed the money to flow out of the corporation to them personally through what's called the CDA, significantly more tax efficiently. So again, I'm going through this really quickly, and corporate taxes require much more depth. But if you have questions about it, we're here to help take these complex things and make them simple, make them easy for you to understand, and kind of help you get steps to move through it. Last example I'm going to go through tonight is Jane. Jane is a planner. She loves looking at her plan. It's all about, again, retirement and her. She's 66 years old. Right now, her retirement is fully funded. She's got her old age security. She's got some pension. She's got everything she needs, old age security. She's not taking money out of her RIF at the moment. She will have to take money out of her RIF when she turns 72. She'll take the minimums. And her intention is she's going to take those minimums and put them in a non-registered account just in case, right? If something happens, but likely that money is going to go to the kids. Jane looks ahead. She likes her plan. Like I said, we are always updating it. She always wants to see the new things. And again, this is very tiny, but when we like our plan and when we're looking at it, and after we've made sure that your retirement is fully funded, we can look at what's called a multi-year estate. It's a great way to get a high-level overview of what do I have left at what point in my life? You know, what do I have in house and camp and lifestyle assets? What's left in my RSPs and RIFs? How am I drawing that down in my TFSAs? All those things. It's a general sheet we like to share with all of our clients. Anybody who's a client has access to this actually online as part of your plan. What she didn't like was the negative number in the red. That negative number that's circled there is the estate transactions, what it looks like when you die. So she really likes the net worth number. I mean, by 2041, doing pretty good. She's got $3.5 million of net worth, future dollars. But she really didn't like that the moment she died, that net worth had a negative transaction. So not only were her kids seeing her die, they were seeing that negative. I said, well, you know, we live in Canada, we pay taxes. There's some planning we can do, but at the end of the day, you do also have to pay some taxes. You know, we have hospitals and roads and, you know, that's part of it. But she was really fixated on that. And she said, you know, if I didn't want my kids to see that, you know, $480,000 negative transaction at time of death, I wanted to prepay that so they didn't have to have it. Kind of like the idea of prepaying the funeral. It's going to happen one day. I'd rather just have it taken care of so my executors don't have that moment or sticker shock. It's going to cost me $26,000 a year when you divide out that over the life expectancy. A lot of money. Like, what can we do? So we said, okay, let's look at the options. We were able to make a plan to take $15,000, so part of that RIF payment out, transfer it over to a permanent insurance policy again, in her case, and come up with a number, not a huge number, but enough that was going to take that estate day and make it positive. That was all she cared about. Doesn't have to be big, doesn't have to be a huge estate. It actually increased her net worth as well. But what she really wanted was when her kids were going through everything, when they were grieving the loss of their mom, she didn't want them cutting a $500,000 check. So it was the emotional tie. Said it doesn't really eliminate the tax bill, but it makes it so the insurance company cuts the check. She's like, I'm good with that. And the insurance company will charge you 15 grand a year and CRA is going to charge you 26. So we made a plan that way. And that's what made her happy. And again, it's about what makes you happy. What's your goal? For some people, you're like, well, my kids can deal with it. For others, you're like, don't want them going through that. I don't want them doing that when they grieve. It's about what's important to you. And that's really what it comes down to. So all those scenarios we just went through are fairly simple. I mean, they don't seem simple, but in the grand scheme of things, they are everyday people that we see on a regular basis. There are much more complex scenarios out there that I'm not going to go through examples of. Beneficiaries with disabilities. If you've got kids that have disabilities or grandkids or anybody you're considering leaving, you need to talk to a professional. You need to talk to a lawyer. You need to talk to us and a team that's going to walk through, what do you need? Do you have qualified disability trust? Do you have Henson Trust? Do you have our DSPs? Are these things set up? Who are the trustees? Again, did you just pick your brother because they're your brother? Or do they have experience with this? Do they have the same investment philosophy? Have you requested that your trustees are going to continue to deal with the same financial advisor so that they know your plan and it's not just going to explode the moment that you pass away? Farms, again, do you qualify for lifetime capital gains exemptions, rollovers? Who's going to stop farming? At some point, some generation of future children are not going to want to be farmers. It's hard work. They just aren't going to want to do it. It's somewhere down the line. Keep that in mind because there's going to be a tax bill due when that happens. So we want to keep that in mind. Same thing with corporations. There are so many planning tools, estate freezes, wasted and freezes, family trusts. All these things are really complex. And it's important that you get a team around the table that includes your lawyer, financial advisor, accountants, and you really look at that whole picture and what that looks like for you. Just because you do it once doesn't mean you're done. You don't come here, listen to us tonight, talk to Linda tonight, go home, write your will, and never think about it again. It should be reviewed regularly. Marriages, divorces, new grandkids, new children, all of these things require you to update your will. We talked about the digital wallet earlier. I don't know about you, but I have 1,000 passwords that all update every 3 weeks. It feels like you need to update these things so they're not old by the time you get there. So it's really important to kind of keep that in mind. Last, acting as an executor. We've talked a lot about planning from the people's dying's perspective, but it's also important to think about it a little bit from your executor perspective. First of all, acting as an executor is optional. So that means if you're named executor, it's optional, but whoever you have named is also optional. So talk to them first. Don't assume they're going to do it. They may not. And you may choose not to, right? If you've got a bankrupt estate, you may choose not to act as an executor. So you've got to think about the complexity. You've got to think about the financial position. I don't know how many people in this room have acted as executors for family members or friends in the past. It's a lot of work. If you've done it, it's a lot of work. The other thing I would suggest is, a lot of people talk about diversifying. They have assets at multiple institutions. I believe in diversifying by strategy. You can have multiple different institutions, investments, but under one roof, because all that adding multiple institutions does is add a headache for your executors. Simplifying as you start to consider your executors and your will is an important part of that, and really keeping that in mind. So both for the people writing the wills, talking about who it's going to be, and when you accept, hopefully the people ask you first if you will be their executor. Ask a few questions. Do you have a digital wallet? How many institutions are you dealing with? Do you have a will? Is somebody going to contest the will? Unfortunately, there are scenarios we go into where we know that the kids are fighting. You've left the camp to your son because he's out there every weekend. Your daughter is going to be mad. Write a letter with it, do something, it helps, right? So keep that in mind as well. Any questions for me before we invite Linda up on any of the things we've sort of covered to this point? Yeah, Mike. Yes, you can. Linda might talk to this as well. In my experience, make sure they get along. Ideally, they are happy to be in the same room. They're going to have to do a lot of things together. And also make sure that when you name two executors, again, if you name your two kids, one isn't the one doing all the work and the other one is who you're chasing down. I will be honest and say, I told my parents, I will be the executor of your will. if you do not name my brother and sister with me, because I'm not chasing my brother down on the slopes out west in Kelowna for a signature. My brother was very happy to say, yeah, let Lindsay do it. I'll just take my check at the end. Keep that in mind. Just because you're siblings, just because you're friends or brothers or sisters, doesn't mean they're both going to hold their weight equally. Don't make your kids hate each other by the end of it if that's what you're looking to do. Yeah. Yeah. Yes, that is a ugly scenario that unfortunately happens more than it really should, because oftentimes there's not a lot left in the estate if you've named beneficiaries on everything, especially if you've sold your house to move into a long-term care or a home or something along those lines. So what happens is they do go back to the beneficiaries, but CRA takes the position that you cannot get blood from a stone. So if one of your kids is the type who got the money from the RIF and went to the casino the next day and there's none left, and your responsible child put that money away and saved for retirement and put it to their kids' education, responsible child is unfortunately going to be stuck paying the bill, and you're going to have a fight, and it's not good. So very important. Again, don't just plan for probate. That's the only thing you take away tonight. Do not just plan for probate. It's relatively small in the grand scheme of things. Any other questions before we bring Linda up from a tax perspective, anything like that? I don't think I see any online. If they come up, we'll be happy to answer them after. For anybody here, we'll be sticking around, but I'm going to invite Linda up, and she will answer all of your questions as well. She's a wealth of knowledge, so we're very happy to have you here, Linda. So if you want to come on up. Just going to get you to push the little button on your microphone here so that the people online don't mind. I'll just. There you go. You're on. You're on. I'll turn me off, and I will let Linda talk.
Okay. I'm hoping there's going to be some questions. Yes.
I want to know if I choose an executor, and I think that's good.
Yeah.
Is there an amount you can, let's say I'm worth $1 million. Okay?
Yeah.
Is there an amount you can take just like that? Or is there a law that says you cannot take more than 10%?
Great question. So the question is, as an executor, are you allowed to take compensation for the work that you're doing? And the answer is yes, you are allowed to do that, but there's no law in Ontario that says exactly how much you can take. So over the years, the courts have sort of dealt with that issue, and there's a rule of thumb that's developed that says that you can take roughly 5% of the value of the estate, but that is subject to the beneficiaries of the estate consenting to that amount. And in the event that they feel that that's overcompensation in light of the amount of work that was put into it. So let's say that the only asset in the estate was a bank account with $200,000 in it, and there was no real estate that had to be sold or what have you. Then getting 5% of that would probably be considered overcompensation. So in addition to the rule of thumb, courts have also said that you can adjust the amount up and down, depending on the amount of skill that you put into the task, the years that it took you to accomplish it, the results that you obtained, and the complexity of the estate. So if it's really complex, there's businesses all over the world and real estate all over, and there was litigation in the estate, that maybe it's not unreasonable that you would take 10%. But then again, that's subject to consent by the beneficiaries. And if they don't agree, then you'll have to go to court and to get a judge to look at your accounts and then approve of your compensation. Well, no compensation is going to be taken until you die, right? Because it's the compensation by the estate trustee. Are you thinking maybe? Yeah. Yeah. Yeah.
Okay, so they are allowed it.
So the amount is typically the rule of thumb is roughly 5% of the estate, but that it depends as well on how difficult the estate is to administer and so on and so forth. That's exactly right. And that's why it can be adjusted up and down. Yeah, so it would typically be it would always be the executor that would do that. I mean, nobody can force you to take compensation. And so in the event that you act as the executor of an estate and the beneficiaries are your nieces and nephews or what have you, often in those circumstances, you would waive compensation. But it would always be the estate trustee that would ask for it. Nobody can force you to take it. Yeah. Yes, and that's another good question. You absolutely can. So for example, let's say you have $1 million estate, you feel that $50,000 in terms of compensation is just too much. You could indicate that they can take a certain percentage of the value of your estate, less than 5%, or a certain amount. It would also be something you can do. That's a little bit more tricky because you don't know what's going to be left over at the end of the day. So that could, again, be overcompensation. So yeah, absolutely, you can do that. But you can't force, as Lindsay was just saying, you can't force somebody to act as your executor. And so in the event that you say, I appoint so-and-so, but he or she is not allowed to take compensation, or he or she gets $1,000, like, or a nominal amount or what have you. And that person might look at that and say, well, I'm not really sure that that's not something I want to get into. So you want to be a little careful with that, and you want to check with the proposed candidate just to make sure that those terms are agreeable to him or her. No, it's not. So anything that you get by way of compensation is taxable in your income in the year in which you take it. Yeah. So so are you saying that in the event that let's say you have 2 children and you appoint both of them to be your executors, and you're saying then in the event that they take compensation, that's taxable in their hands. Yeah, you're in that situation. They wouldn't take compensation because it would be taxable there in the hands, whereas receiving a benefit from the estate is not taxable.
Tax based on the state income tax, and now you're making your executor pay tax too. So if your executor is your beneficiary, they get the money tax free, right? The tax happens at the estate level. So you die, your estate pays tax. But let's say I'm leaving it to my kids don't pay any tax. But if my kids are my executors and I compensate them as executors, my estate paid the same amount of tax, and now my kids also have to pay tax. So if your executors are your beneficiaries and you compensate them, you double tax them. If they're even, right? So if they're 50-50 executors, 50-50 beneficiaries,
yeah,
they're double taxation. You don't want to compensate them, double taxation.
Yeah.
What about it?
Yeah. So if you want to provide your estate trustee with the option of taking more than 5%, that's absolutely something you can do. Yeah, you can absolutely do that. And if you do it, the advantage of you putting that in your will, then they don't have to go and get the consent of the beneficiaries. That's something that you have provided, an option you provided to them. I've never, ever heard of anybody challenging that. No. Good question, though. Yeah. 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 Mm-hmm. So, yeah. Yeah. Sure. Yeah. 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 So that's another really great question. So I think the question is, I have a will, I've appointed my spouse to be my executor first choice, and then if he can't act, then I've appointed my brother-in-law. Is there some way that that can be altered without me having to change my will? And the answer to that is yes, that can be done. So let's say that you die, you both die, And then let's say that your brother-in-law then is pursuant to the terms of the will, then is the executor of the will, and he doesn't particularly want to act. And there's his niece and nephew are adults and could easily do the job. He can sign a one-page document called a renunciation, whereby he just says, I'm not going to do it. And then that would leave the door open to the nearest next of kin to then become appointed as the executors. And that would be your kids. Yeah. Yeah. That's exactly right.
Do it while you're alive.
Yeah.
Get it
Yeah.
changed
Yeah.
instead of after
Yeah.
you're dead.
Yeah, that's exactly right. Yeah. 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 So that's a great question. So I think that one of the scenarios that Lindsay was touching on, it was a cottage, and the client wanted to give it to her son. And sometimes my clients come to me and they say, well, I'd like to change the ownership of the camp. I want to leave it to my sons. I want to put him on as a joint tenant on that property so that when I die, that goes straight to him, bypassing my estate, no probate fees, and so on and so forth. That's never something that I recommend for a whole host of reasons. First of all, I believe that that would trigger capital gain if you put your son on title in your lifetime. Then Revenue Canada will deem you to have disposed of the property at that point in time. That will then trigger the capital gains to be paid at that point in time. Whereas if you leave it to him in your will, then you're not going to be able to burn it. That's going to be paid by your estate. But second of all, the more people you add to your assets in your lifetime, the more you're diluting your own financial interest. So you don't know what the future has in store. Nobody knows how long they're going to live. We don't have that crystal ball. And it's very possible that you might need to sell the camp and live off the proceeds of the sale of that property. But if you put it into joint ownership with your son, then ostensibly he owns 50% of that property and could insist on getting that in the event that you were to sell it. You would be stuck paying capital gains taxes and he would get 50% of the value of that property. And so that's certainly unfortunate. Another thing that could happen would be that in the event that your son, let's say he's in a bad accident and there's not enough insurance to cover it, there's a huge judgment against him. Those judgment creditors are going to go out there and look for anything that has his name on it. They're not going to care that he's just on there for convenience and estate planning purposes. They could put a lien against the cottage, sell it from underneath you, take their judgment and take off. Or I'm painting this son in the bleakest possible light here, but let's say that he goes bankrupt. There's nothing stopping the trustee of bankruptcy from going after that property as well. They could sell it from underneath you, take the money and give it to the creditors. Or if he should separate and or divorce, his spouse might have something to say about the property as well. Could very well be deemed to be a matrimonial home at that point. So for all those reasons, I never recommend it. I think that unless you're absolutely sure and certain that you're not going to need the money for that camp in your lifetime, then just don't do it. Keep it in your own name. And then at the end of the day, when you die and you're not going to be there to feel the burden of that, then the taxes can be paid at that point in time. Then son can get the property and you're not going to live to see the pain of that. Yeah, so that will depend on your asset mix. So in the event that there's a whole whack of assets in your estate that will attract capital gains taxes, and there's going to be a lot of taxes payable and so on and so forth, you want to make sure that those taxes are going to be paid from your estate. And so you could look at that and see maybe some of them you could designate your estate as the beneficiary of, which means then that would be probate fees payable on them. But as Lindsay was just explaining, probate is just 1.5%. So nothing to lose any kind of sleep over. So in the event that, for example, the situation is what Lindsay was explaining, that there's RSPs and in the estate, and then there's a cottage that will attract a capital gain, and you want to leave that cottage to your son, then it may make sense for you to flow the insurance proceeds into the estate so that the capital gains taxes can be paid by the estate, and then the son can get the cottage without it having to be sold in order to pay for the tax liability.
One thing we can do is we can create the projections, and it sounds good, but we do kill you off every couple of years. And you see how much is in the estate, what is the liquidity? Okay, what's the risk that there's not enough liquidity? And then you can determine, okay, do I name beneficiaries or do I have it flow through the estate? Because it is very different. Again, these are examples. They're not meant to be used as like hard and fast rules. Part of the reason I even use a couple-year-old taxes is just so people don't use them as hard and fast rules. So you have to look at each individual scenario, but that's something we can definitely look at. Okay, what does this map out as? What's the liquidity risk? Then you can make an informed decision as well. I think there were some questions coming through on the, if you want to just read them out off the screen. Oh, okay.
That's perfect. Okay, great. Thank you so much. Yeah.
The other side, the side.
So the question is, what happens in the event that you transfer your, you designate the RSP, the daughter as the beneficiary of the RSPs. The cottage is still part of the estate though, is that what you're saying? Or
I think it was rolled directly to the son. So the estate got the tax bill and nothing else, and it ended up bankrupt.
but how was the cottage left? Was it put into joint ownership with the son? Okay, it's put into joint ownership with the son. So the cottage was put into joint ownership with the son. The daughter was designated as the beneficiary of the RSPs. There's no money left to pay for the tax liability in the estate. What happens is the question. And so my understanding is that under the Income Tax Act, the CRA has the ability to go after the beneficiaries under the RSPs in order to satisfy the tax liability. Yeah. Yes, an estate can definitely go bankrupt. Yeah. Yeah, but the CRA will try.
And I would add to that, maybe, Linda, if you can clarify, if the money was dispersed before maybe it should have been and before there was a clearance certificate, the executor can also be named and CRA can also come after the executor as responsible because the estate wasn't bankrupt to start. It became bankrupt based on distributions that happened.
Yeah, so using a different example then, in let's say that there's an estate where there is a cottage and there's RSPs and there's enough money to pay the tax liability, but the estate trustee decides to, instead of paying the tax liability, just distributes the balance to his niece and nephew. Absolutely, in that situation, the estate trustee would be personally liable for the income taxes. In that, the first charge on an estate are the liabilities of the estate. You have to satisfy those first, means permitting. And if you don't, then you just distribute the money without taking care of that and without getting your clearance certificate, then yeah, absolutely, as an estate trustee, you can be held liable for that tax liability.
How many months or years are you allowed? Like, I die tomorrow.
Yeah.
My executor has all along to give what is in the will.
So they are allowed to give what's under the will, but they need to make sure that they take care of all of the debt first. Anything that's owed by the deceased estate has to be paid out first to those creditors. Once that's been done, and then once you have applied for and received something called a clearance certificate from Revenue Canada, which is Revenue Canada's guarantee to the estate trustee. They've gone behind the last couple of tax returns. They haven't found the tax liability. And even if they subsequently do, they're not going to go after the estate trustee in his or her capacity as the estate trustee for having distributed the estate without having satisfied that liability. And then you've advertised for creditors and done all the other stuff that you're required to do, looked for any kind of debts of the estate, and then you distribute it, then you're okay.
when I die, does she, the executor needs to go to a lawyer for the will?
So the question is, my will was done a while ago. When I pass away, will my daughter be required to go see a lawyer in order to probate the will? And the answer to that will be that depends on how you're holding those assets. So in the event that, let's say that the only assets that you have designated beneficiaries on, or you put them into joint ownership, there's no other assets that flow through your estate, then essentially there's no estate there. And there wouldn't be a need to get probate in order to deal with the estate. But that's not always something that you can do for the reasons that Lindsay was just articulating, in that if there are debts related to the associated with the estate, then there has to be some liquidity to pay for that. Otherwise, the CRA is going to go after the beneficiaries under the estate. So you want to make sure there's enough money there to pay for the expenses. Otherwise, it's going to be nasty.
Again, the lawyer is the small cost. the income tax, the fighting, siblings fighting, all of that sort of thing. That's the big cost. So it's probably worth paying probate and paying the legal fees, I would definitely say.
Yeah.
Again, having seen a few of those.
Yeah.
In terms of, you did ask clearance certificate, how long it takes, it depends on the will. We've seen some take a few years or longer, depending on the complexities. That said, if all of the assets are held within one institution and we're notified right away, we can wrap them up in a matter of 4 to 5 months, because we can run an estimate shortly after we're notified. We know what the final tax bill is expected to be if we know all the assets, and if we have all the details and the plan is accurate, we know all of that. We can actually freeze the accounts, send it out to your accountant, whomever that is that you're dealing with, or your tax preparer, have a list for the lawyer, it's all there and ready to go. And because, again, you've got all your experts working around the table together, it can be wrapped up substantially quicker. And then you don't have to file tax returns over 2 or 3 years, and estate returns and this and that and the other. But it is going to take a while for CRA to get the clearance certificate. It can take longer than a year, depending on the complexity.
Typically it would, yeah.
Yeah.
The CIA is not a fast-moving and efficient
Yeah,
machine.
we can be quick.
Yeah.
We can't guarantee what
Yeah.
CRA will
Yeah.
do.
It can be up to 2 years. And
Yeah.
often they lose those requests for a clearance certificate, and you have to go back and file them again. And it's never their fault. It's always your fault. So, yeah. Yeah.
Is it legal then, I guess, to give your kids, like, tell them where your debit card is? They went into your bank account and withdraw whatever they can, just so that they can see the referral or.
So that's another great question. So you're saying I die, and I want to make sure that my accounts are not frozen so that my kids can pay for the costs associated with the administration of the estate. It's not, they technically can't, right? Because that debit card belonged to you, and it would just be something that you could use in your lifetime. But more importantly, they wouldn't need to, because all of the major banks will always allow the payment of estate administration related expenses. So the kids would just go to the bank, provide them with a copy of the invoice for funeral expenses, probate fees, all that stuff that needs to be paid, and then the banks will just make payments directly to those third parties. So it's not necessary, and I really don't think it's a good idea for anybody to have your debit card. You keep it to yourself. Yeah. Yeah. Yeah.
And my father refused that everything.
Yeah.
When that happens, what do we have to do? Can we call?
So in other words, so the question is it true that in the event that I have a spouse and everything that we have is joined, and I've designated her as the beneficiary, when I pass away, there'll be no estate. It's not necessary for me to have a will. Yes, that is true, but how does your dad know that he is going to die first?
That was like,
Yeah.
Counting the days.
Yeah.
things happen. There's no guarantees.
Yeah. And so if he holds off, let's just say that, theoretically he's correct. So if he dies first, and everything, and if everything is joint as between the two of them, and he designated her as the beneficiary. Yeah. So if he designated her as the beneficiary on his registered assets, and then he held all the other assets that non-registered jointly with her, then absolutely there would be no estate there. But let's just say that that's his plan. But then she dies first, and then he's not capable of making a will at that point in time. That's the problem, right? So really, my recommendation, of course, would be that he gets a will.
Well, Linda, can you just clarify not capable of making a will? Because I think that's a
Sure.
really important point
Yeah.
that people don't realize. They
Yeah.
think they can always get to it later or change
Yeah.
it later.
Yeah.
And
Yeah.
that's not always. So what do you,
Yeah.
can you clarify what you mean by not capable of
Yeah,
making a
so
will?
there's a test that's sort of like you have to be capable of making a will, you have to be capable of making powers of attorneys, and the tests are different. So the test for being able to make a will has sort of developed in the courts, particularly by one particular case called Banks and Goodfellas. And in that case, they indicated that in order to be in a position to make a will, you have to have some knowledge of what you have and the approximate value of those assets. You have to know approximately how you're holding them. So are you holding them joint or are they just in your own individual names? You have to have a knowledge of your family and who they are. So you have to know that you have a spouse and that you have kids and so on and so forth. And you have to be in a position to understand anybody who might potentially feel that they have a claim against your estate. You can't suffer from some kind of delusion of the mind. So if, for example, you feel that you're not going to leave anything to your son because he's planning on killing you, he's been slowly poisoning you for years, and there's in event that there's no truth to that, then you kick it, then you don't leave him a benefit under the will, then that you don't have the capacity to make a will at that point in time. That doesn't mean that you can't have delusions. You can, but provided that those delusions don't impact on your estate planning, then that would be fine. You might still have capacity. So if you feel that the government is poisoning you and you can't stand Pierre or no Justin Trudeau, and that would be a completely different matter because that's not going to impact on your estate planning. You never plan to leave anything to him in any event, so that's not going to be something that would prevent you from making a will.
That is true. And I think just a second note there, you know, you made the assumption that all the joint or all the non-registered assets are joint. Occasionally, people have an individual GIC, an individual bank account. They don't have their spouse's name on it for whatever reason. It's not uncommon that, you know, he has his little bit of his play money and she has a little bit of her play money. That happens very commonly. That's not a joint asset, which again is an estate.
Yeah. And if there's no will, let's just say, for example, your dad had $1 million sitting in a non-registered account in just his own name, and then he died, and he doesn't have a will, then under the law, your mom would be entitled to the first $350,000 of that, and the balance would be divided between her and their children. So she wouldn't get the entire $1 million, and that's probably not what your dad intended. Not that he has $1 million, but I'm just saying, just for the sake. Yeah.
Lots of nuances.
Yeah. Yeah. No, it doesn't have to be. In fact, you could make your own in doing something called a holograph will, which is a will that's wholly done in your own handwriting. It doesn't require witnesses. The trick is you need to make sure that you dispose of your estate. That doesn't always happen. I can tell you from experience.
And just a note, as she said, the whole thing has to be done in your handwriting. If you type it up and sign it, it's not your handwriting.
Yeah.
So those rules are like the back in the day, like pen to paper, not keys, iPad, whatever it is.
No, not if it's wholly in your own handwriting. Yeah.
Yeah.
Then it's a holograph document. Yeah.
So again, lots of little detailed nuances that you may not.
Yeah. Yes. Yes, typically it would. There would be a paragraph in the will that says that I revoke all prior wills. So yes, typically it would. Yeah. 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 You're not wedded to that lawyer for sure. Yeah. Yeah. You revoke the document by way of the next one. It's the last one that counts. Yeah. Yeah. Nothing.
Hopefully you have better beneficiaries, but other than that.
Yeah. So that's a good question. So yeah, sometimes you can admit a photocopy to probate in the event that there are circumstances which would prove that the original will has been lost, not because you intended to revoke it, but because of somebody destroyed it or there was a fire in your home or what have you. But there have to be some pretty specific circumstances present for you to be in a position to admit a copy to probate. Yeah. Yeah, go ahead. Yeah.
So you don't keep a copy in your office? But it's will?
No, I don't do that because we just don't have the storage facilities for that. I mean, we have electronic copies of everything, but we don't keep any kind of, to a few of our clients, if they don't have any place to store their documentation, we have a vault where we can keep it, but we prefer for our clients to take their stuff home.
Lawyers.
No, she is a lawyer. So that's what it's subject to the lawyer. Some lawyers do, some do not.
Yeah.
Depending on
Yeah.
how many clients and how many
Yeah.
wills they have.
And I typically
to store.
don't really recommend it because lawyers retire all the time, right? And then you have to chase them around to try to find the original will and so on and so forth. So it's really just in a situation where my clients just don't have any other place to put it. And then I always recommend that it's a temporary holding spot for them to keep it.
And lawyers do also die. They are human.
They do. They do. Yeah.
And that becomes, we've seen that.
Yeah.
Then it becomes also very hard to chase it down because it's
Yeah,
not like they're
for sure.
retired and you can find them.
Yeah. Yeah. I would recommend it. You don't necessarily have to. You could do something called a holograph codicil. So a document, again, wholly in your own handwriting, and then you could indicate what it is you want to change in the will. But it's a little technical, so you might want to be careful with that. Yeah.
Was there an online question there, Jake?
Yeah. 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 Stop here. Yeah, that's a good question. Very good question. So does anybody have a right to contest the will? Well, you have to have standing, first of all, right? So you have to be somebody who either receives the benefit under the will or would have received the benefit under the will, or if they hadn't changed the will or what have you. So there has to be, you can't just sue Justin Trudeau for making a will where you're not left anything. It has to be somebody that you feel they have a moral obligation to leave you something. And then there has to be some very specific reasons for you to be successful. So anybody can sue anybody, but you need to, the operative question really is, how likely are you to be successful? And so in order to get a will set aside, there has to be some specific reasons for it. The two most common ones are, did the testator have capacity when he or she did the wills? And we were just talking about that. And so let's say that that you know for sure that your dad was completely off his rocker. He didn't know what he was doing. He thought that you were poisoning him. You really weren't, and so on and so forth. And he did a will where he left you nothing. Then you could bring a motion that the will be set aside because your dad just didn't have the capacity to make a will. So in those situations where I meet with clients who are thinking about disinheriting one of their children, and you know for sure that that child's not going to like it, and it's probably going to bring litigation to get the will set aside and so on and so forth, then I typically recommend that they provide me with as much detail as possible for the reasons why they're doing that. And I'll generally make reference to those reasons in the will just so that it's going to be clear to a judge looking at the will later on that this was something that they gave some thought to, and these are the reasons for it. It's not just something that they did because they thought that their son was poisoning them. It's because he hasn't spoken to them for 20 years, and then whenever he came around, he was almost fighting with them, and he told them he hated them, and all those things. And then I typically recommend to them as well, write it down in a separate letter. Then that letter would never see the light of day unless there is litigation brought against the estate. And just go into detail with respect to why it is that you're not leaving anything to son, and he's a horrible human being, and this is what he said, this is what he did, and so on and so forth. That way, that letter could then be shown to a judge. If there is litigation, the judge can then see, well, yeah, there's all kinds of good reasons why you didn't leave anything to son, and then that ground could be taken out of the equation. Another reason why somebody could bring a claim against an estate is on the grounds of something called undue influence. So a son could bring a claim for that the will be set aside because sister has been gossiping about him and saying all kinds of untruths about him to dad and making him feel that he's a horrible human being when really he is like the next best thing to Jesus Christ. And if it hadn't been for that information being fed to his father, then he would never have done the will that he did. So he was under some misapprehension with respect to the actual facts. So those are the two most common reasons. Another reason why you could bring a claim against the estate, not necessarily getting the will set aside, but bring a claim against the estate, is if you're dependent on the testator for support. So let's say that dad has been providing son with financial support over the years, and then he leaves a will where son doesn't get anything or doesn't get enough from the estate to feel that he's been supported adequately, then son would be in a position to bring a claim against the estate for support because he was financially dependent on the testator and he wasn't provided with what he considered an adequate amount under the will. Yeah. Yeah.
How should we protect against passwords?
Lindsay, did you have any suggestions with respect to that? Typically, I just put a paragraph in the wills wherein I indicate that the estate trustee will have access to the passwords. I don't usually go into detail.
Yeah, so the will itself just has a clause in there that says they have access to this, it's available, and usually we suggest have it on like a key fob, have it on a letter that's again sealed, that's not meant to see the light of day until you've passed. Keep it in your safety deposit box or wherever you keep your will that's special, your insurance policies, all those things. It's meant to be a sealed letter. It's not, those passwords aren't part of the will because again, some of them you got to update every forever. So you don't want the passwords as part of the will. They're two kind of separate pieces. One goes with the will, but the will has to make reference that they have access to those and that they can get, if they're locked out, for example, for some reason, they can get your passwords. They have the right as your executor to distribute that property and give it to your kids or whatever it is, right? Or cash in your. So there have been court cases, and obviously Linda can talk about this. It's gray. The court case that really kind of that I was referring to is actually in the case of a divorce, and who has access to the photos on the iPad is actually a legal court case that lots and lots of fighting was done over. It does happen.
Yeah.
So I'll let Linda speak to the actual legality of who gets the points and how that works. But it is definitely, well, you did my will. It's definitely a clause in my will that says, you know, the kids get the points and the, you know, all those things.
Yeah.
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 They don't have that. Like that information.
It's like cash. That's just cryptocurrency is like cash. It's gone. If you don't have the password, it's like you have thrown your money into the wind.
The other thing Huge issue. Buy a lockbox. Where's the key? I must have gone through the. I open up.
Yeah.
I wish
Just having a safe without a key or a password is not helpful. And FYI, fireproof safes aren't heat proof. So if you have something that melts in them, this is a completely different thing, but my husband's a firefighter, for those of you who don't know, they're not heat proof. So if you have something that melts on top of your documents, like new money melts in heat, they are fireproof, not heat proof. Keep that in mind.
What about the freezer?
The freezer is also not fire. I can't tell you how many cold Canada savings bonds I have seen in the last 15 years of my career because they come out of the freezer. Freezers are not fireproof. I feel like that's a myth. I don't know where it started. Maybe old freezers were, but freezers are not necessarily the safest place to keep your documents. But many, many, many people do. But many, many, many thieves know that. So my parents had their house broken into a couple years ago. They rifled through the medicine cabinets, the bathroom drawers, the jewelry thing, and the freezers, and nothing else because the alarm was going off. So that's a common place, just an FYI, not a financial planning tip. Yeah, go ahead.
They're going to.
No, so the principal residence exemption is available to the taxpayer and not to the estate. So even if the principal residence exemption is available to the taxpayer, not to the estate. So in the event that the house stays in the estate for a period of years after the deceased passes away, and it increases in value from when he or she died until it's eventually sold, that would be a capital gain that would not be exempted.
You have to be alive to have a principal residence,
Yeah.
simply put. So even if it's in the estate, you're dead, you don't have a principal residence because ostensibly, yeah, you're in the ground somewhere. It's from the time you die, essentially, is when it stops being your principal residence, whether it's in the estate or it's been moved to your children.
Yeah.
Yeah,
Yeah.
from the,
Yeah.
I mean, if it's grown in value over a year or two, depending on the market, obviously. Mhm. Yeah.
Yeah.
Mhm.
Yep.
They have to disclose assets to all the beneficiaries.
Regardless of whether or not the executor is a beneficiary, all of the assets have to be disclosed to all the beneficiaries. No, I know you're talking about reading a will, and so that doesn't really happen anymore. What happens is that at the end of the day, when the
That's okay. You can,
estate trustee has paid off the liabilities, it's time to distribute the estate, he or she will send out a letter to the beneficiaries, providing them with an accounting of what's come into the estate, what's gone out in terms of the expenses, what's available for distribution, the amount of compensation he and she intends to take. And so at that point, they're going to find out. It's definitely something. Transparency is key with respect to all of this. The more you sort of keep everything sort of held tight to your chest and don't disclose anything, the more suspicious the beneficiaries are going to be. So you need to be as transparent as possible. And they have every right to know what is in the estate and what they're entitled to get.
that said, things that pass outside the estate, insurance, segregated funds, those kind of things, you can have a named beneficiary, and that is not made public because it's not part of the estate. So if you were trying to leave more money to one child for some reason, or you had a partner that you didn't want somebody to know about, or a illegitimate child, or something like that, you would have to do that through something that passes outside of the estate, because the estate actually becomes public knowledge as well.
Yeah,
I can
yeah.
Google
If there is probate, then
somebody's
it's
probate.
filed with the court. Yeah.
Yeah, so I could go Google, the Rogers estate if I was so inclined, or, someday when Musk dies, you can actually go and Google and find out exactly what was there when he died,
Mhm.
because it's public knowledge after you die. Anything that flows through probate through the estate is public knowledge for anybody who cares to dig. Yeah, exactly.
The question is, how soon after somebody passes away do you have to let the banks know?
Is that involved?
Well, not completely. The banks will still pay for certain estate administration expenses. So anything to do with the funeral expenses, taxes, and so on and so forth, they will pay for that before there's probate.
Yeah.
Yeah, all of that stuff. Yeah, for sure.
Of any substantial?
They will certainly not make payments directly to beneficiaries. But that would be something that you would do at the end of the day when you've satisfied all the creditors of the estate.
The sooner you tell them, the sooner you can.
Oh, that was
start
the question. I'm
process.
sorry. Yes. So-
As well, right?
Yeah.
So it's, hiding it and having somebody take your credit card and take the money out, again, to avoid a little bit of probate,
Yeah.
could be a big problem down the line, right?
For sure. Yeah.
Generally speaking, the sooner you tell them, the better. You can also then, because you got to get values of those accounts on the day of death, especially if they're investments,
Yeah.
all those values have to be in there. They have to be provided to your accountant.
Yeah.
So the sooner you do it, the less work it's going to become, because the
Yeah.
longer it carries on, then you may have tax returns over multiple years. You've got rates and things like it just can become more work. You think you're simplifying it by not following the rules, but it usually comes back to bite people from what
Yeah.
I've seen.
For sure. All right. I think that's it.
So thank you everybody for coming
Yeah.
out. Thank you, Linda, very much. As always, you're a wealth of knowledge. So anybody has any questions, we'll be sticking around for a little bit. But again, thank you guys so much for coming out. There's definitely some food left over, so help yourselves. We won't be eating
Yes,
pizza
I
for a
am.
month. And thank you to everybody online. Thank you very
Consider
much.
that to me.
We have recorded this.
Yes, for sure.
So if you are interested in a recording, we'll reach out after. We can send you a virtual recording of this as well, so that you're able to play back. If you've got questions, of course, we're happy to help. So thank you, everybody. Thank you to everybody online as well. We will end the meeting now, but if you have questions, feel free to leave them in the chat and we'll reach out to you.